Breaking news, markets have crashed to levels not seen since Friday of last week, and a whopping one of the 20-plus supporting evidence charts signaled risk off today. Oh no, it was the gamma flip, it was the zero DTEs, it was the holiday trading volume. No. The only reality is that there were more sellers than there were buyers, but yet the daily trends remain in the upward direction. So let's keep it cool here and take inventory of what we've got and build a game plan based on logic for the remainder of this week. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so. And stay tuned until the end of today's show. I've got 10 additional trade ideas to share with you that you won't want to miss. 5 of them are long, 5 of them are short. With that said, let's jump right into the charts. So let's kick things off on the SPY weekly time frame chart, just so we can see how damaging the stock market crash has ultimately been. In terms of weekly trend, we know we've been in an uptrend for quite some time, coming from the lowest lows nonstop to a higher high, especially over the summer rally highs as well. There was no hesitation, a little bit of a daily balance over here, but the breakout was quite forceful in the upward direction. Now, we'll always concede when there's a slight change in tone. This is the first time that we've broken over a previous weekly high, and we're starting to show some indications of closing back within the previous weekly range. But what do we know about forming a higher high in the trend count? Ultimately, the market can afford to look for a weekly higher low, and the level that we've been tracking or paying a lot of attention to recently is at 459. Is it totally logical that the pullback has to start somewhere? Absolutely. Is this a market crash? Far from it. If we do continue in the downward direction, a retest here for a weekly higher low, and then looking for trend continuation makes a whole lot of sense on the higher time frame charts. The daily time frame chart is still technically in an uptrend as well, as we mentioned in the intro, but this one's not as clear to count, so let's do it together, starting from the CPI gap up. There's a low, here's a higher low, here's a higher low. This is technically a nuanced higher low, and because we did flip into an hourly downtrend here over the Thursday and Friday session of last week, this technically counts as the next daily higher low. And what you'll notice along the way is that we had highs, we had higher highs, we had higher highs, we had higher highs, and even in this morning session, we broke to brand new higher highs. We're pulling back from that higher high, which means we can afford a higher low pullback on the daily time frame chart. And as long as we're above the low of last Friday, technically speaking, we can get a very nuanced higher low. And I don't know about you, but this is that nuanced higher low. Now, I'm not going to sit here and argue that this is a bullish looking daily bar, not by any stretch of the imagination. We have an upper wick that breached over the previous day's high. There was no support during the consolidation on that breakout over the previous day's range. We failed into range and some, obviously. It's much more of a bearish engulfer, taking back about 3 or 4 days of consolidation, depending on how you want to count the Tuesday session of this week. And we've closed extremely weak on the lows. This is happening on a slight uptick in volume once the breakdown started to unfold. So overall, is there some substantial movement behind this bar? Absolutely. But is the trend in jeopardy? Not yet. If this is going to turn into a daily trend reversal, what you kind of need to see, because we're coming from a higher high double top potentially, is not only a breakdown through the, let's just call these equal lows for the sake of pattern, right? These equal lows here around 468.50. You need to break through that to provide a lower low on the daily time frame chart, produce a lower high because we're coming from the higher high, and then you'll be in a daily downtrend. And what do we know about that? Well, first and foremost, the origin of the FOMC breakout can act as potential support, and it's the lower bound of this week's expected move. I wouldn't second mortgage the house on the lower bound of the expected move. You can clearly see that the market's been violating expected moves wildly over the past couple of months, but there's an opportunity there for some sort of reversal or consolidation, which brings me to my next point. Because we basically just have equal lows after a higher high, I would be open to the market cooling off, going sideways. Remember that expansion leads to contraction. Expansion can lead to a time frame of contraction. So if the market wants to build out another balance area up here as a possible daily bull flag, like what it did over here, this is a balance range, and if you give it some context, it turns into a bull flag. If that wants to happen, as long as this equal low is holding around 468.50, there's nothing wrong with the market cooling off here and then possibly breaking out for the Santa Claus rally, which happens after the Christmas holiday and 2 days after the new year. So that would be a very interesting possibility here. The other thing to at least discuss is that the market was somewhat overbought, right? The big argument was that the market was overbought. It's impossible to get in on long entries. Everybody's looking for this pullback. How can we get involved in the move? This is your Christmas gift, right? If everybody's been looking for a pullback, anybody who's missed the rally from the breakout of this balance range, this is the pullback that they're finally have been waiting for, and your wish has been granted ultimately. So instead of thinking about this through the lens of, oh my goodness, the market is going to crash and go to zero, all of the supporting evidence behind us really suggests that the buyers remain in control. Risk on is still the current mode of the market, and at any levels of support underneath us, we should be thinking about possible reversals. So as we mentioned, the first one is here from the FOMC origin, 465 down to 464.25. If you get some sort of like daily double bottom down here and then reverse back in the upward direction, that would strike me as bullish. We're looking to be buyers down here at this level. Or if we flip into a stronger daily downtrend, if this is not going to produce a consolidation range up here via a lower low, lower high, and then some sort of breakdown through here, we know we're really focusing on the weekly higher low level at 459. Can we trade shorts to get there? Absolutely. But do we want to overstay our welcome here on the short side? Well, based on the momentum of the weekly chart, my answer would certainly be no. Let's get even more granular on the SPY hourly time frame chart and talk about trend. We're going to start from the Monday session just so we're all on the same page. We had a higher low, higher lows, and higher lows into the afternoon session today. Then we had highs, and higher highs. So this was definitely an hourly uptrend here. And this, of course, is a large bearish engulfing move. It would be absolutely insane to say anything other than we have flipped into a very firm hourly downtrend. And not for nothing, but let's even take it to a 15-minute chart here and take a closer look at this afternoon's move. You can see some lower highs underneath that structurally relevant area at 471. And also, because I want to have a timestamp for all the trolls in the comments section, we recognized that this was a fake break and there was the possibility for liquidation break into the afternoon, and we caught a nibble of this move. Am I going to sit here and lie to you and say, oh, we expected this huge breakdown to happen? Absolutely not. We were just looking for the previous day's value area high. But we did nibble on a little bit of downside there, right? Your time frame of analysis needs to match your time frame of execution. When we're talking about weekly time frame charts, we're not talking about trying to catch a breakdown on a 15-minute chart. But anyways, let's go back up to the hourly and talk about trends and what we can expect going forward. One of the things I want to point out here is remember that Thursday of 2 weeks ago is the origin of this move, and not for nothing, but coming in from that Thursday low up to the highest high of today's trading session, your 38.2 is right here. So it makes a lot of sense if the daily chart cannot produce a lower low, which would require breaking down underneath this 468.50-ish area. If we do not get that lower low and we're just consolidating up here, that's healthy bull flag consolidation over a 38.2. Let's take a quick look through the lens of the anchored view apps intraday, see what these might suggest. These would certainly pair with the downside activity. What you'll notice is the FOMC anchored view app, that's the main one that we're going to focus on for today, is right here, confluence at that 471. So the game plan going forward is because we're in an hourly downtrend, you can find a lower high under 471 on a little bit of an oversold bounce here. As long as it produces that lower high, then great. We'll keep a very, very close eye on 468.50. If this catches up for confluence and then we break it after a lower high, so if this is the H pattern setup, a breakdown there brings us to the origin of the FOMC breakout, right? And we know that we can potentially look for buyers here. So we'll be keeping an eye out for any sort of double bottoms, inverted head and shoulders, or very simple hammer candles. If that doesn't hold, then we'll go to the weekly higher low, right? And of course, at that point, we would likely be in a daily downtrend, producing some sort of lower low underneath here. And it's very likely that you could produce a lower high on the daily chart as well. You'd be in a daily downtrend. We'd be a little bit more cautious about being so gung-ho about buying the weekly pullback until there's actually evidence of buyers stepping up. What do the buyers want to see? If this is going to hold, if that 38.2 is going to produce daily just consolidation going sideways, if this is only going to be an equal low after a higher high from here to here, then ideally the buyers just get some sort of higher low over 471. Any shorts late to the party that we just saw in that 15-minute bear flag, they get squeezed out and we just chop sideways here. This is a chance to accumulate. Remember again that we get sideways compression leads to expansion, sideways compression, we stay in this range. If we get accumulation ahead of the, quote, Santa Claus rally timeframe, I think that this is the gift the buyers have been waiting for. If we get that higher low over 471, that would be the first indication. Any sort of breaks back up and over 473.25, I think that this market flies up towards the all-time high. It's just one scenario, and it would require that higher low over the 471 level. As of right now, on the smaller time frame chart hourly, let's be very clear here, we are technically in a downtrend. Lower highs can be found under 471. If we get some sort of head and shoulders that might look like this, an hourly H pattern, we'll look for the downside. But as of right now, none of the supporting evidence charts would really align with a continued big market crash. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's do a quick compare and contrast of Tuesday's session versus today's session, and I think what we'll find is that we have totally just liquidation break on our hands. Volume flows are steadily building all day on Tuesday, and we closed substantial up and over positive 300 million. Today, we don't build at all during the day. It's not even negative. It's trying to fight positive. Then it's liquidation break. That's really not indicative of stronger, more methodical sellers. Same thing with the advanced decline line. What you'll notice here is that we're up in trend higher zone all day. This morning, we open negative, fight positive, which is a bullish indication, and then it's liquidation break. And even at that, we really don't get into trend lower zone, even at the close. Cumulative build on the tick, same thing down here. You'll notice a substantial sort of increase here. Same thing happening over here, and then it's liquidation break into the afternoon. So stronger, more methodical sellers were not sitting on the, sort of offer, just, sell, 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 sell. It wasn't the case. This is totally emotional breakdown over here. And generally speaking, if we can get a substantial retracement of that move, short-term momentum sellers should be out of this market. That yields daily bull flag consolidation that we were just referring to. That strikes me as a bullish opportunity for the market to continue the weekly uptrend. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Find some very interesting things here on the market profile. If we're thinking about value area and point of control, it was steadily migrating higher throughout the duration of the week, and even on today's session, it did move in the upward direction. The thing that I find interesting, though, is if you actually extend the low of the value area from the Tuesday session, that's exactly the low of day from where we opened up on A period this morning, and that's where the single prints really separate an upper distribution over here. This would be distribution 1 from a lower distribution down over here. So instead of stronger, more methodical sellers entering this market, it seems to be a case of buyers with terrible trade location turning into overhead supply, stopping out of positions, maybe paired with some profit taking, which causes this big emotional reaction in the downward direction. Now, again, this aligns with the idea that if we can see a stronger retracement and we don't technically have stronger sellers, these are just short-term momentum sellers or even buyers who are late to the party with terrible trade location. Again, that indication comes from the breakdown of the value area low here, producing overhead supply, right? That weighs on markets in the downward direction. If these are just emotional sellers, short-term sellers, overhead supply closing out of badly located longs, and we can retrace that, then it's giving buyers another opportunity to, quote, load shares down here at better prices. Now, we do have a spike to contend with. This is the other nuance to be thinking about as we move into tomorrow morning's session. We have an M period spike, just like we had an M period spike for the Tuesday session over here. If we open above the base of the spike, and I'll give you that number right now, let's call it 4760. If we open north of 4760, the market should auction higher because we have trapped shorts with terrible trade location, right? The target would be the top of the sort of lower distribution and the beginning of the single prints. That level, to give you a number here, is going to be at 4783.50. That would be your first upper target. If we break above that, of course, it's the single print rotation through the low volume void. You can just see that in the volume profile over here, and the base would be the target up around 4807. All right, that would be your upside target. That's if we open above 4760, above the base of the spike from this area here. If we open in the spike, I'd be very open to the idea of lower highs being found, and any breakdowns underneath the base of the spike should continue to lead the market lower in an attempt to try to find buyers at some sort of lower level. The level that comes to mind is the origin of the FOMC breakout. Here's one more for you. If you take a look at the SPX options chain, what you can look at is the sizzle index over here, which measures on a relative basis to a 5-day rolling average how much volume was flowing through the options chain. And what you'll notice is that there's not a huge disparity between the put sizzle index and the call sizzle index, generally indicating that we don't have a major gamma squeeze, in this case, in the downward direction. If that was going to be the issue with the market today, the put sizzle would read at something like, I don't know, a 6, and the call sizzle maybe at something like a 2. It's simply not enough of a difference here to indicate that people were overly aggressive on the put side, the market makers needed to cover, and you sort of got this big spread in the downward direction, just not there. And even if you look at the SPY, right, we could do the same thing. I use the SPX because it's a larger product, but look at the difference between what we have over here. Again, let's just think of this in terms of percentages. It's about 0.3 of a point there. It's just not to the magnitude of what would constitute a gamma squeeze, in this case, in the downward direction. Let's change gears and take a look at the QQQ weekly time frame chart. Now that we know exactly what we're looking for based on the S&P template, we can speed it up a little bit. QQQ weekly chart is in an uptrend. These were higher lows. We broke to higher highs. If we were going to find another set of weekly higher lows, something that looks like this is certainly constructive on the higher time time frame. QQQ daily time frame chart is slightly different because our daily trend is not the same. We have lows equal lows, and this breakout has not yielded a pullback whatsoever. On the hourly time frame chart, the closest we got to a downtrend was the Thursday session of last week, but even at that, look at how we've closed back up near the Wednesday highs of the previous FOMC day. So I wouldn't count that as a daily high or low. And instead, because we do have a bearish engulfing bar, again, don't get me wrong, the daily bar is certainly not bullish by any stretch of the imagination, but the trend is up. We can look for a higher low around the origin of the FOMC breakout. That level is about $400.15 down to about $399. We're also getting the lower edge of this week's expected move for confluence around that particular zone. So what does that mean? Again, if we get there, you're looking for hourly trend reversals and then a move back in the upward direction. If there's a sharper reversal to begin with, and we just get something that pops immediately back up towards this all-time high into the end of this week, this is nothing more than beautiful, healthy bull flag consolidation. This is definitely an hourly downtrend, so this would be the daily high or low, correct? Then if we were to break out of the flag, we know that we're staring at blue sky territories up overhead. Lastly, the hourly time frame chart. You can certainly see that we had lows, higher lows, even higher lows during the afternoon pullback from the Monday session, paired with highs, equal highs, higher highs. All-time highs were found on today's session. And then we've broken down. There was a subtle divergence that happened into the afternoon session. We broke to a higher high in the morning, and then of course we actually found a lower high in the afternoon, and then we've broken down regardless. Of course, this was our last hourly high or low. This could even be counted as an hourly high or low, and we've closed underneath both of those areas, so we are technically in an hourly downtrend, just like the S&P. What the sellers ideally want to see here is just a lower high set anywhere underneath 406.25 to set up the move to the daily high or low zone, which is at $400.15 that we were just referring to, confluence at the lower edge of the weekly expected move, as well as the origin from the FOMC breakout in the first place. When we get here, we are looking for hourly trend reversals via a double bottom, via an inverted head and shoulders, or just a very simple hammer candle. So thinking about that, if the continuation is in store for the end of the week, lower highs that are underneath 406.25, keep that trade on the table. What the bulls want to see clearly is just a retracement of this move and a higher low above that really gives us the daily bull flag consolidation that we were just referring to, and as we know, we have blue sky territories up overhead. In terms of Fibonacci's and an anchored view app, let's come in from that Thursday low, just like we did on the S&P, coming on up to the very top. We are not even at the 38.2 yet, and you'll notice that the FOMC origin is kind of in between the 38.2 and the 50% retracement. So overall, a little bit of continuation lower. You have some confluence around this zone. $400.15, $400 flat makes a lot of sense as a daily higher low pullback. You're kind of around striking distance from the Fibonacci point of view. And if we take a look through the lens of anchored view app, we're underneath, just like in the S&P, the FOMC anchored view app here. And again, any lower highs that continue to be underneath 406.25 make a lot of sense for continuation towards this zone down here. Notice that this will slowly roll over and provide confluence now that we're getting some more bearish price activity. Market internals for the NASDAQ are almost identical to the NYSE, illustrating liquidation break here, illustrating liquidation break over here. A little bit more of a bearish edge out of the cumulative build, though, from the tick, noting that we didn't build in the upward direction and then fall from a positive read. We actually did dig a little bit deeper negative into the afternoon, and this really shouldn't come as much of a surprise considering what happened with the intraday divergence that we had just discussed on the QQQ cash market. So we are getting that same little bit of a retracement over here. The indications are the same that this is weak-handed emotional selling. If we can retrace a little bit more, we would start to think that, okay, short-term momentum shorts are out of this market, leaving the door open for buyers to step in, looking for a daily higher low and continuation into blue sky territories. And again, I want to be very clear here that these are definitely bearish reads by the time the day closes, but the context that they sort of give us, the clues that they give us about who's participating in this market is really what matters more. We're not arguing that this is a bullish dashboard by any stretch of the imagination. Let's take a look at the market profile for the NASDAQ side of things. Same comments over here with your value area and point of control elevated in today's session. You have the same thing, single prints, and a little bit of a spike at the base of today's session as well. I'll give you the numbers. The spike base is going to be at 16,789. 16,789. If we open underneath that level, the market should auction lower, looking for buyers at a lower price point. If we open above that level, technically these sellers late to the party at the end of the day should squeeze, and the target would be the top of the lower distribution here. That level is going to be at 16,872. Then your single prints technically close way up here, closer to 16,971. You are still getting that very mechanical interaction with the value area low from the Tuesday session and the beginning of the single prints from today's session, furthering the idea that this is liquidation break from overhead supply, not necessarily stronger market sellers. And to finish off the broad market, we have the IWM on a weekly time frame chart. How are the small caps doing here? Very interesting that right off the top of the range, we are starting to reject a little bit, pull back in. But is this surprising? If you recall from the Monday night episode, we said this is the fastest rotation from a 52-week low to a 52-week high. We've gone wall to wall from the bottom of the weekly or monthly balance range to the top. It wouldn't be unreasonable for a pullback here, some sort of weekly high or low, a reattempt to the equal high should be what it takes to open the door and break out of this monthly balance range. So I'm not writing this off. This is not a bearish looking chart. It's just at the top of a balance range. If we can look for a higher low, ideally that probably wants to be, structurally on the weekly, that probably wants to be around 190. That would be a hold of your weekly 200 SMA. But let's take it on down to a daily time frame chart here. We're just going to go straight through on the Russell. We know the trend is up, right? A daily higher low, we were talking about weekly higher low at 190. A daily structural level that makes a whole lot of sense would be a retest of 187.75, which was clearly this ascending triangle or bull pennant that broke out during the FOMC speech. And then, of course, here we had the gap up from the following Thursday. The most concerning thing about the daily chart that does have me a bit on edge into the end of this week looking for continued pullback is that we have the same daily bearish engulfing pattern, but this is a balance range. It's a 3-day range, and we had a look above and fail. We've already targeted the bottom end of the range. That trade is complete, so to speak, but we know that this gap underneath is a little bit menacing. So don't get me wrong, we have a daily uptrend here in the IWM on the small caps, but if we start to move into this gap, there's nothing saying that we shouldn't close the gap. That would be from 196.50 down to 193.60. That would act as a pretty major headwind for your S&P and your NASDAQ. So if the IWM is going to close the gap, I would think about continued pullback over in your S&P and NASDAQ. If the IWM can hold this gap and it does not move into or underneath, I should say, 196.50, this is like about as bullish as consolidation as you can get, right? You failed, but you did produce a higher high. You traded back to the equal lows, and then you continue to hold there. You get one more chance to produce a higher low, something that looks like this. Otherwise, if you just consolidate here for too long, obviously the threat becomes some sort of head and shoulders. Then through the neckline, you close the gap, and we get the pullback anyways at some point in the future. So IWM is a very simple watch. It's are we over or are we under 196.50? There's not much to elaborate on from an hourly time frame chart perspective. If we take a closer look, a beautiful hold like this morning, again, credit where credit is due, this helped inform the decision for early morning rallies. IWM pulled back aggressively out of the gates. There was almost a micro liquidation break off of the open. We caught support at the top of the balance range from here, 199, and the market was off to the races. That was the indication for a SPY long. Now, the liquidation break into the afternoon, the much more meaningful one, went right back to that key level. So once again, no need to overcomplicate things in small caps. 196.50 is your key level. Again, could the weekly chart use a pullback? Absolutely. If we go gap close and then find buyers here for a gap fill reversal, that would be a very bullish weekly pullback, not even approaching the 190 level that we saw structurally, but also the daily level at 187 that we were just talking about. Lastly, what we can do is bring out the Fibonacci's just to remain consistent in our process, and we'll come in from the FOMC low because the Thursday low didn't really kick off anything substantial in the week prior over here. So we'll come in from the FOMC low up to the most recent high, and your 38.2, again, not for nothing, you can't make this stuff up, guys, is right at that 196.50-ish zone. So if we find support here, there's nothing saying that this isn't technically healthy-looking bull flag consolidation on the daily. Continue that and break out in the future. It's a really good look for the weekly time frame chart to exit that overall balance and really spend some more time up and over the 200 figure. Lastly, we'll throw on the anchored view apps from the intraday point of view, see if these are informing any decisions. And so far, a little bit more bearish than bullish, right? Failing the anchored view app from here, no higher low, although it was kind of nice in the morning session, sort of supporting around that 199. But for now, underneath both of those, even from the FOMC breakout. So the more time we spend underneath, I think it just really reinforces 196.50. There's no need to complicate things, as we were just saying on multiple other charts. Here are the Russell internals: liquidation break, and liquidation break over here. All of those concepts are the same as what we've discussed in the other indexes, and you can take a look at the market profile. This is slightly different. The Russell does have a nasty habit of putting through the most volume in that closing 15-minute period or 30-minute period in the case of market profile, and the point of control did flip lower as compared to what we saw over in the NYSE and the NASDAQ. The other big difference that I'm sure you can tell is we have a poor high up here, and there are no single prints that really separate A period, K period, and then the lower distribution from the break into the afternoon. So for the most part, this kind of makes sense that consolidation through that range wouldn't be all that far-fetched. You can still see visually that there's the most volume up near these highs, so you have overhead supply, which again caused the market reaction in the downward direction. So I'm not writing those things out the window here for small caps, but overall, again, consolidating inside of the balance zone makes a lot of sense. It's not overly bearish until we actually move into that gap. You can see that the spike is pretty precise with the lows of that area until we actually break down underneath, giving the buyers the benefit of the doubt. You can apply the spike rules to the Russell side of the market. Notice the M period spike on the lows. If we open above that spike, I'll give you the number right now. It's basically where we're trading in the overnight as I'm filming here. It's at 2014. Let me know your favorite song from 2014. But if we open above that, right, these shorts are technically underwater. As we open, we should get a little bit of a squeeze. We're not talking about, again, a big break to a new two-day high or anything like that, but a little bit of more upward pressure from those shorts closing out. If we open in the spike, we'll learn something when and if we drift into the gap underneath us. Let's get granular and take a look at the weekly performance of our S&P sectors. Some market crash when we still have a green sector out there. Communications led the pack, or they're leading the pack, up 1.25% on the week. And at the bottom of the barrel, it's the XLU for utilities, down about 2%, 1.97 to be exact. XLC is a risk-on sector. XLU is a risk-off sector. Not really seeing any concerns from a posture perspective as the market is pulling back over here. If we take a look for the XLK, the tech sector, the heaviest weight risk-on sector, not even down a percentage point on the week, 82 basis points to be exact. But because today's episode is all about market structure, let's take a look at the trends here and actually evaluate, like, do we have issues from a trend point of view? XLC certainly not. Pulling back from a higher high in the sequence, an opportunity for a higher low here over 71.25, or even the origin, see this as consolidation, right? The origin of this breakout closer to $70.25. So no issues trend-wise here. That is a risk-on sector that does look more bullish than bearish. Here's the XLU, a D for defensive sector. It is risk-off. Here's the origin of the October breakdown. We are actually underneath that. We're coming from the highest high that we've just produced, but this maybe could be considered some sort of like very, very tight hourly head and shoulders. Maybe we're in a downtrend technically, if you want to count this as your last consolidation low. So downtrend. Let's just say it's in a downtrend, right? Does it matter? This is the XLU. These are utilities. These are a risk-off sector. Certainly not a concern if we're thinking about posture for the overall market. Here's the XLRE for real estate. Opportunity for a higher low over 39, or even from a weekly point of view, higher low over 37.80. We're pulling back from a higher high. No concerns from a trend perspective. Here's the XLB materials, the lightest weight sector for the S&P. Just produced an equal high to back over here. Gap fill reversal strikes me as being constructive if we can hold 84. Even if we dip a toe underneath, because it's such a lightweight sector, it's probably not going to have a whole lot of pull for the S&P as a whole. Next up, financials definitely has a lot more pull than your XLB, so let's take a second and talk about it. Here's an overhead balance range. We've broken down underneath the flat lows. Are we coming from a higher high? The answer is absolutely. There's an opportunity for a higher low here on the daily chart around 36.30. I mean, not for nothing, but just like IWM small caps, right? You've come from maybe not a 52-week low, but the lows here, of course, the SVB brought in the 52-week low, but a fairly substantial low during this pullback after the summer highs to exceeding the summer highs and some, and now we're pulling back with an opportunity to find a higher low above. It's just very difficult to say that the market is crashing when the sectors, structure-wise, trend-wise, look as they do. We're pulling back from the highest highs. Again, let it move through the thin structure. Find a weekly higher low here. It would be welcome for a more constructive or sustainable move in the upward direction. Next up, XLP. D for defensive. It's going to be a mirror of utilities, basically higher high, sort of head and shoulders type thing over here underneath the origin of the October breakdown from in the past. Lighter weight sector, D for defensive, seeing it, move like this to the downside, falling into maybe a daily downtrend with highs, lower highs here, not as concerned. XLI for industrials, definitely a little bit more of a risk-on indication. Balance range overhead, broke down from the balance, certainly an opportunity to find a higher low over the previous all-time high. It would have been too good to be true if it was $111.11, but unfortunately, it's $111.12. You get the idea. You can find a daily higher low here over that previous pivot, or if the weekly chart is going to find a higher low, you pretty much just want to stay over 109. We're pulling back from this highest high. We technically have poor highs up here as well. It's a mechanical level. The market should not end or produce an all-time high like this. So as a weak level, it could use some repair in the future, just carrying that forward as a small data point. About 8% of the S&P in industrials, right? Next up, XLV. Opportunity for, maybe a lower high here on the daily. Technically, we've broken down underneath the pullback low as well to originate this, but as weekly consolidation, monthly consolidation, if we can hold 132.65, not the end of the world. The reason that we don't want to see this falling off of a cliff and in an aggressive downtrend is because it's the second heaviest weighted sector by market cap. But as we know, it's also D for defensive. So if it does drift into a very mild, controlled downtrend, this is the heavyweight sector that you want to see do it. You don't want to see the XLK. Speaking of, any issues from a trend point of view on this chart? Absolutely not. Here's an all-time high. Here's a pullback underneath the lows of this consolidation. Thin structure to retrace. Any issues? Not really. Looking for a daily higher low above the previous all-time high. Again, the main illustration, walking through all of these charts, they can remain constructive from a trend point of view. The SMH for semiconductors is going to look almost like a mirror image to that XLK all-time high over here. A little bit more of an aggressive breakdown, but you can see that you're getting that same indication of the previous all-time high offering a potential higher low. What we're looking for is previous resistance to turn into newfound support. That would be constructive for the trend overall. We have lows, higher lows, find some sort of higher low here. Along the way, we had highs, higher highs, reasonable that a pullback could unfold and the trend could continue. Even if we're going to flip into like weekly consolidation, I mean, you're consolidating at all-time highs. It's very difficult to be a bear when markets are at all-time highs. Let's take a look at the XLY, what's going on with the XLY. And of course, we know that the market pullback has to come from somewhere. The all-time high eventually will lead to a downturn, but as of right now, things do remain constructive. XLY, right? Higher high, pulling back, gap close, also bullish, even a weekly pullback down to here, 170, 150. That would kind of be your line in the sand. Actually, I take that back. I apologize about 170, 150. The big level that I would think about is this previous shelf here at 175, sort of where this breakout came from. 175 kind of line in the sand. But again, we're coming from the highest high, so the trend remains constructive in the upward direction. Last but certainly not least is the XLE for energy, drifting higher after what was a range breakdown from here, but pretty much on the premise of the tensions over in the Red Sea. So if that's going to continue to play out that way, you could watch for a possible range break high over 85.50. And that would sort of be like an inverted head and shoulders neckline break. If that happens, your target's very straightforward. The previous flat top from here at 87.60. But remembering that this is a lightweight sector for the market, it's also not it's not like a big risk on, risk off indication. Maybe global demand for oil becomes slightly concerning from a growth perspective. But right now, like this is not do or die, basically, is what I'm getting at for the S&P. Let's take a look at the ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, this continues to support the idea of risk on with the XLK for high and tight consolidation over here, and still well above an upward sloping 50 SMA. XLV, which is a risk off sector, is certainly underperforming underneath a downward sloping 50 SMA. XLF pulling back from a higher high in the ratio, searching for a higher low, strikes me as constructive. And a similar comment here for the XLY consumer discretionary. That is a risk on indication. XLC is trying to perk up. It's gotten back to the 50 SMA, but ideally we get it up and through. It certainly could be the case with the relative strength that we're seeing on the week thus far. Risk off is not an issue. Risk off is not an issue. And this is sort of neutral here from an energy. And we know real estate is sensitive to rates, so this little outperformance is not really a concern from a hard asset point of view. We could take a look at some specialized ratios as we typically do. XLK over the SHY, mild pullback, but again, what's the idea here? We just came from a higher high. It's not really a risk-off indication. Similar comment over here with the XLK over the XLU, breaking to a higher high and basically flat on today's session, even as the market is pulling back. This is not an issue from a risk-off point of view. The market is still very much so in risk-on mode, meaning that people are willing to take risks out there in equities. Here's the XLY over the XLP. This also is a risk-on indication, discretionary versus consumer staples. It looks good. So far, all of the evidence stacks up as this being a mild pullback, maybe not mild, maybe a harsh pullback until proven otherwise, right? You really need to flip into downtrends. You need to see relative performance change, and then we can start to talk about a potential narrative shift here. Let's take a look at the dollar because this also remains floored. This did not elevate at all, putting downward pressure on equities. So the dollar wasn't really the culprit of what moved the markets today. Again, it really speaks to liquidation break and shorter term sellers being the ones who, momentum sellers, emotional sellers were the ones who caused the move, right? Here's gold. This really didn't do anything impressive either. It's still stuck in a balance range. And we know that the precursor to gold recently has been the silver contract. Did silver do anything impressive? Is this what the market's all freaked out about? Not really. Pretty much just flat, maybe a fake break up and over these previous highs. But for the most part, metals, the dollar, not really influencing what happened in the market today. We can even take a look at interest rates. You might think like, oh my goodness, did the Fed say something? Is the market crashing because all of a sudden higher for longer might actually come true? I mean, the TNX is just printed a brand new lower low. So certainly not interest rates, which are causing the move in the downward direction here. Let's take a look at the inverted ZT. This is continuing to drift in the downward direction, which would imply rate cuts, right? So let's take a look at the tracker tool. So the probabilities remain unchanged from what we saw last night, still expecting about 6 rate cuts from the Fed in 2024. That's what the market's pricing, and the SEP has outlined at minimum 2, with the median projection drifting from 5.1 to 4.6. That's 50 basis points worth of cuts, obviously at a minimum increment of 25 basis points, 2 cuts based on the SEP. So again, the market's not crashing because the pivot is sort of of off the table now. We're still pricing in the same exact thing as yesterday. Is it possible that the market's thinking, oh, maybe the PCE number is going to come in super hot on the Friday morning session? I would be hard pressed to imagine that, especially if we just look back at what happened last week. I mean, the PPI was floored. It was at zero, even on the core. CPI is moving in the downward direction. I can't really imagine a world in which the PCE is dramatically higher on Friday, but hey, I guess we will find out. As we priced in yesterday, I mean, based on the EPS, it's certainly possible that targets for 2024 could get as high as something like 5,200 if we do ultimately see a PE expansion based on 6 rate cuts. You can watch last night's episode if you're interested in seeing that full breakdown, but let's quickly go through some of our additional risk on or risk appetite charts. The TLT ratio to the S&P is certainly moving in the upward direction here, but again, this is not as much of a concern if we pair it with additional context like what we see out of bonds in relationship to themselves. On today's nasty Armageddon sell, again, the bond market is not the one driving this downside activity, which speaks to liquidation break. And as you know, the premise of today's video is that liquidation break is not bearish, it's actually bullish. It's going to clean out short-term momentum sellers if we can retrace the move. Bonds are not suggesting that, okay, we're suddenly seeing something that we didn't see just the other day. We're still drifting into downtrends here, here, and here, correct? That's the premise. Same thing can be said over here with credit spreads. There's a mild uptick out of the medium duration. That's your IEF LQD. This is your shorter duration SHY HYG. Mild uptick, but again, I mean, we just broke to brand new lower lows. Credit spreads are tightening. This is not indicative of a credit event at all on the horizon that the market can at least sniff out as of right now. So not really seeing that as a risk off indication. It's risk on, as a matter of fact. Let's take a look at the HYG in isolation. This is actually, it went from being a bearish divergence yesterday, producing the equal high. We talked about this in last night's episode. You could go watch it. But we said if we take out the neckline of what could have been a double top, then we would be concerned about the S&P. Now look at what's happening in the HYG. It's producing a higher low into today's afternoon session, whereas the S&P is actually producing an equal low. So I just kind of find that comical here. And if the HYG is going to lead the way, it should suggest that this is, again, just a liquidation break and not much more than that until proven otherwise. We could take a look at Bitcoin, what's going on with the digital gold. It remains high and tight for consolidation up here. That is a risk on indication, although not one-to-one with equities down below, as we well know. Let's take a look at breadth. Breadth is continuing to improve, getting a mild uptick still on the week. In terms of new highs versus lows, that is not a bearish indication. That does not align with a deep, dark market crash that everybody is talking about. Same thing over here in the SPX A200R, continuing to move in the upward direction, or even just sideways up near these highs is really not a bearish indication over the 50% mark. And sure, you could talk about contrarian indications here on the SPX A50R, being that we're, pressed into like 90%. But for the most part, this is not a bearish indication. If anything, it leads to a little bit of a pullback, and that's what we're seeing so far. That's the case for today's video. But it's not like, oh my God, we're down here, the market's selling off, and like there's no light at the end of the tunnel. This is like, no, things are in recovery effort, and higher lows are welcomed on a weekly time frame chart. Let's take a look at some equal weight indications. RSP is up first on the chopping block. Sure, a mild pullback, but again, is there an opportunity here for a higher low? Absolutely. Would it have been better to stay outside of these prior highs? Yeah, of course it would have been, but there's still an opportunity to remain constructive on the overall trend. I really wouldn't want the RSP at this point to unwind anything more than $150.25. That's kind of a line in the sand as we walk forward in that one. QQQE is a little bit better. You can clearly see that it is holding up even as we're pulling back mildly, but we are pulling back a little bit. We've sort of got a bearish engulfing over the previous day's range in here, but as long as we're over that 80-90, that again remains constructive for the weighted NASDAQ, which of course is down below. Now, transports have the ability to prove themselves. If we're looking at the industrials versus transports, if we can hold a higher low, don't get me wrong, nasty daily bar on the transports here. We closed the gap overhead and then reversed all of it back down into the close. But if we can hold up over this prior pivot top, and roughly speaking, we're talking about 15,700. If we can hold that for a constructive higher low, then you're just getting stair-stepping activity higher, which of course has to be more bullish than bearish. Obviously, industrials went on to break a big-time new all-time high over on that side of the market. So not much going on in terms of bearish divergences. Again, I think all of the data points really suggest that this is a liquidation break. It's a pullback until proven otherwise. I I've been saying that until I'm blue in the face tonight. It's just kind of interesting. Here's the VIX, a little bit of an uptick, certainly coming from the floored lowest lows that we've seen in a very long time, ever since the pre-sickness era. Not really much of a concern, though. We could take a look at the VVIX itself, and although it's creeping higher, are we up and over 103? Are we in the precursor zone? Absolutely not. If we take a look at what's happening from a volatility futures point of view, mild uptick, but volatility futures aren't even pricing in some sort of backwardation here. Like the one-day VIX, sure, it got elevated, but these are levels that we saw last week as well. So are we concerned from a vol point of view? Not really. Again, liquidation break is the name of the game. Higher low pullbacks until proven otherwise. Trends are strong. Weekly trends are strong. You know where my head's at. Apple kicks off the core list of companies on the hourly time frame chart. What do we see here from a trend point of view? The largest concern I have is the all-time high, lower high, and lower high here. But for the most part, this could be construed as a balance range. So technically neutral from an hourly point of view, unless you really want to consider that all-time high. So 195 lower highs underneath get interesting for continuation. But you guys know how I feel basically about this liquidation break. What I would prefer to see is demand step back up at this area of support. And you can see in the pre-market or post-market right now, we're actually trading higher from where we've closed. So the oversold rally, as long as it stays in this zone, it's really hard to be an aggressive bear out of Apple until we get the lower high definitively underneath 195. Obviously, the buyers want to see this turn into a double bottom with a first higher low here over 196.85 and then a breakout through 198 to test the all-time high. Next up is Microsoft. Speaking of balance ranges, this is just absolutely brutal. It reminds me of what was going on with Meta, right? So look above and fail, look below and fail, look above and fail. We're in the midpoint of the range. Total back burner until something more constructive happens outside of that range. Next up is Google, gapping up this morning on some positive news, but closing as a daily inverted hammer. Remember, folks, we're still on the hourly time frame charts here. Superimposing the daily bar, it would look something like that. If we can short underneath today's low, we are looking for a deeper retracement towards the consolidation in here. I'd be partial to that's going to be a very difficult short to pull off. The better short, of course, is breaking down underneath 135.30. Like we consolidate in here. Maybe you could call this some sort of nasty looking head and shoulders, right? And then we break down underneath that neckline. That unlocks the thin structure and the daily 50 SMA retest at 133.35. So if you're a short, you might have to be patient here in Google, and there has been relative strength with the gap up from this morning. If it just chops around over 139, how could you say anything other than hourly bull flag consolidation on the higher time frame charts? It would also look good on something like the daily. Next up is going to be Amazon. What's going on with Amazon? Very clear indication of a double top closing underneath the neckline here. So the name of the game is lower highs below 153.25 continue to trade in the downward direction for a retest of 150. But as we know from the daily point of view, this was a constructive range breakout. We did hit the daily double. If we just go ahead and move on out to the daily chart, right? We've doubled we've doubled the daily range. There we are. So that trade is complete, and a higher low to retest the 2-day highs from back here would not be unreasonable. That was that 150 that we were just referring to. Let's drop it back down to the hourly chart. Obviously, a higher low here turns this into look below and fail. The target would be the top of the range at 155.25, one step at a time. As of right now, remaining underneath 153. I would tend to think that this would be your higher probability outcome into the end of this week. Next up, NVIDIA. What's going on with NVDA? Taking a closer look, we've already got the playing out of the head and shoulders from this point of view underneath that neckline. So the name of the game is lower highs beneath 489.50. Keep the bears in control. If we do continue lower, some consolidation here to build out a bear flag, and then it's a higher time frame Man Ray pattern. We haven't talked about Man Ray in a while, but there he would be, right? Consolidation here, then through your neckline, that would be at 476. Then we are looking for lower prices to retest that daily 50 SMA. If the buyers are going to make a stand, you guys know exactly what I'm about to say. You need to get a higher low over 489.50. You need to get back up here, and then maybe some sort of trendline break gets interesting for a continuation play in the upward direction. If you're thinking about a daily time frame chart, you have daily lows, higher lows, maybe higher lows if we can get an immediate reversal, consolidate here, and then get that higher low. Let's just go to the daily chart so we can see it, right? You can see this slow grind, lows, possible higher lows here. If we hold this, possible higher lows, right? We're pulling back from the all-time high area. That is the constructive look. Holding this, consolidation back up here, then maybe this looks something like a cup and handle, and you get some sort of break to blue sky territories. Next up, Metaverse. What's going on with Zuckerberg's Fantasyland over here? Remember that this is basically the equivalent of what Microsoft is now feeling like. But let's go on down to the hourly chart here and see what we can see. more so constructive in the upward direction. The liquidation break into the afternoon was not nearly as aggressive out of Meta. We are holding on to this key structure at 347.50. Consolidation here keeps a hourly bull flag, daily bull flag alive. Breakouts over 353.25. Target should become 359.50. If we sweep it, obviously just trade to your next level through the thin structure retracement. The better retest is down here at 337.25. I would not put as much weight into that 342 target. That is your better daily higher low, right? The retest of the 2-day high breakout, which led to this most recent leg up. Next up, we've got Tesla. What's going on with Mr. Musk and the rocket ship? This is another one with a beautiful retest, right? So this retest of 246.25 on the liquidation break does strike me as very important because we know that this is a daily balance range, and usually speaking, the longer the balance, the larger the breakout. So if we can hold higher lows above 246.25, then great. This really sets up a continuation play, not a large breakdown. If this is going to play Microsoft on us, then what it's going to do is basically on the hourly chart, slip underneath, find a lower high, and then what's the target? It's the bottom end of the range for a look above and fail. So 246.25, very straightforward pivot out of Tesla. We're still on the daily time frame chart. This is Netflix. Just want to point out how far through the overhead gap we've moved, mostly closed, but let's bring it on down to the hourly chart now so we can see the structure and how it's unfolded. Notice that we did not get the ideal hold of 490.25, but what's the saving grace, right? If this is liquidation break and we are going to retrace some of that move, this is technically high and tight consolidation. The trend remains clearly in the upward direction with lows, higher lows, higher lows, higher lows, possibility for higher lows around 490.25, but ideally we would recapture that far sooner in the morning session as opposed to drifting lower, because then what's the threat, right? You turn this into some sort of head and shoulders. Now you have issues back down underneath 481.75. All right, 10 trade ideas. Are you ready? We're going to start on the short side of the list here. Morgan Stanley is up first. Daily time frame chart now. What you'll notice is what appears to be a daily bull flag, but we technically have an inside bar here with an inverted hammer testing those highs and closing weak near the lows. If the market is going to move lower, this wants to turn into overhead supply and retrace the thin structure down to the origin of the gap up move at 87.20. The gap closes at 86.10. If we take it on down to the hourly time frame chart, you can see that this hourly bull flag did not yield higher results, and we closed underneath the open as we saw from the daily red bar perspective, taking out these lows. Now you have overhead supply way on price in the downward direction. You'll notice a theme here on our short trade idea. So that's Morgan Stanley up first. Next up is Boeing Airlines. BA is the name of the game. And can you already tell what I'm about to say? It's the same thing. You could probably imagine what this looks like on a daily time frame chart, but here's the hourly. This is your balance range. It is not broken down yet through 260.50. If it does, we have thin structure to retrace, and a target would be down here around 251. So slip it, lower high, look for continuation to retrace the thin structure breakout. Here it is on the daily time frame chart. Just an absolute, like, this chart belongs in a history book, to be quite honest with you. But we have a engulfing bar technically. This is not an inside bar, it's an engulfing bar where we made a new higher high, we failed, and then closed on a lower low. So thinking about the downside for that retracement we just discussed on the hourly. That's Boeing. Next up is HD Home Depot. What's going on with Home Depot? You can see that we've got a very similar idea, bearish engulfing bar, little gap to close underneath. Here it is on the hourly time frame chart. The idea, the premise behind all of the short trades is that the market has further to fall, and we're looking for thin structure retracements coming from overhead supply. So we have not broken down through the equal lows yet. 348.25 opens the door for 343.60, and then a thin structure retracement from the FOMC breakout brings you to 335. That is Home Depot. Next up is going to be IBM, International Business Machine. There we are. Here it is. We finally don't have an overhead supply. Well, it will turn into one, but for the most part, this on the hourly time frame chart still is a head and shoulders. You can clearly see your very equal lows at the neckline here, here, and here from today's session at 160. Breaking down underneath, lower high. You guys know the name of the game. We are looking for 158 as a downside thin structure retracement for a target. Last but not least, on the short side is going to be PEP. Oops, not OEO. PEP is the name of the game for Pepsi. And this one could honestly go either way. Let's go to the daily chart just so we can understand, right? So we have a failed breakout from the range. We're back inside with a lower high. Now we're trading at the equal lows, but we do have the 50 SMA for support. So there are two ways you could look at this. If the market continues to move lower, you could look for the hourly short to get to the retest of the breakout point from here, or you could start to segue into the long side of our ideas and say, no, I'm going to look for that pullback and then a weekly higher low or monthly higher low, whatever, somewhere here at the 163.30 area. Let's take a look on the hourly time frame chart. The interesting part about Pepsi today was that technically speaking, this is sort of a very ugly head and shoulders, but we gapped down. We opened on a gap down. We got a perfect gap fill reversal. Here is the Tuesday low. Here is the Wednesday high. Gap fill reversal closed weak on the lows. And as we just saw from the daily chart, there is some room to run, maybe not huge room to run, but there's at least a scalp. There's a day trade to be had under 165.75 into 163.30. You could look for the support here and then a reversal. It's one idea, but Pepsi really strikes me as a short trade first because we're in an overall downtrend. We have not retraced to these highs from the summertime move or even late fall if you want to consider it that. We already have the daily lower high, right? So to me, much more of a short. Let's transition over to the longs. First up is ORCL. ORCL is the ticker on that one, and we're still on the daily time frame chart, folks. You'll notice that these ideas all revolve around pullbacks holding prior structure. If we can hold this level here, 103.15, looks pretty darn good for continuation in the upward direction. We've already broken down from the overhead supply, right? Let's get that really weird price shift off. There we are. So this is the overhead supply. We broke down looking for a little bit of follow through from our sellers to retest the double bottom neckline. If we can hold the daily higher low here at 103.15, looking to pick it back up in the upward direction, of course, you would have to get the retest of 105 as your first possible target. So continuation, double bottom, inverted head and shoulders, the whole 9 yards we're always looking for. To pick it back up, 105 becomes your target. So that's a pullback trade out of ORCL, bullish from that point of view. Next up, TSM. You'll notice that all of these are in sort of the tech sector. TSM is a pullback into prior resistance, which we are now looking at as possible support. This would have to have a very early turnaround on tomorrow's session. Again, this really plays off of the premise that liquidation break is short-term momentum sellers. And if there's really not aggressive sellers from a daily point of view, here's the daily chart. Beautiful breakout of this prior level, right? Little pullback happening. If we can find buyers here, it would be a very constructive daily higher low lows, higher lows, higher lows. We've already broken down from the overhead supply, so this would be more of a pullback buy contender. Next up, so from TSM, we go to MU, Micron Technologies. It's the same concept, just at a different price point here, a little bit cheaper, right? So if you prefer the options over an MU, there's your retest level, big break to a higher high, pulling back aggressively. If we can find buyers around 78.40, looking to pick it back up, and again, your target would be the lows of where we've broken down from. I would use 80.80 as that upside target, right? A retest of the origin from the breakdown. So if we find a lower high there, then great. High, lower high, equal lows, treat it as a double top, and then we'll go through on the second go around. But as of right now, finding buyers first strikes me as a priority if the broad market is moving in the upward direction. Next up, we've got Shopify. SHOP is the ticker on that one. You guys can, the pattern is very clear. Things that we're looking for shorts in have overhead supply. Things that we're looking for longs in they've already pulled back to a retest level, right? So 74.75 is your retest. Finding buyers here, looking to trade back up towards the equal highs. Here it is on the hourly chart. Let's find a target together. It'd be I would be thinking about this as the first place to target. So 78.40 roughly. Retrace the thin structure. Liquidation break is proven, and this is consolidation over and above this range from in the past out of Shopify. Last but certainly not least, for our 10th trade idea tonight, PYPL. PayPal is the name of the game. What do we see over here? This one's got some room to fall first, but if this is a double top, we are in a downtrend, don't get me wrong, but we have broken out, this is sort of like a weekly inverted head and shoulders. So the retest of 60 makes a lot of sense to me. If this is a daily double top, breaking down through that neckline, looking for some further drawdown, retest 60. Can we find buyers here? That's the name of the game. If so, you guys know what we're looking for, a retest of the origin of the breakdown. Let's go on down to the hourly chart. So first place I would be thinking about is here on your first reattempt around 61.80, and then your highs up around this level at 63.65 become the next target if we can find buyers at 60 and if the broad market is holding up strong. I want to just say one last time as a blanket statement, if the market continues to pull back, we will look for the short trade ideas. If the market retraces the liquidation break, we will look for the long trade ideas that we just finished on here with PayPal. That's going to wrap it up for today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comment section. If you made it all the way to PayPal, let me know you made it to PayPal by dropping something random in the comments section. I'll probably be able to figure it out. Maybe I will, maybe I won't. But I hope to see you in tomorrow morning's pre-market prep. We have an interesting day on Friday with the PCE. We will have coffee and donuts for the last day ahead of the holiday. Come hang out with us. It's live here on the channel every morning at 8:15, and it's completely free. It's open to the public. So come hang out. With that said, I wish you a green trading week.